Hi, welcome to this quick tutorial about bond issuances at par. In this tutorial, we are going to walk through the basics of bond issuance and interest calculations. An organization can borrow funds by issuing bonds, which are promises to pay back the funds borrowed. A liability is created when an organization issues a bond. Organizations issue bonds to raise funds for operations, expansion, future prospects, and the like. Issuing bonds will increase cash, which is an asset. Issuing bonds will also result in a liability, bonds payable. The bond's face value is the amount that must be paid back at maturity. Face value is also known as maturity value. Bonds are typically issued in $1,000, $5,000, or $10,000 increments, or other even amounts. There are two interest rates associated with bonds. One is the coupon or stated rate. This coupon rate is used to calculate the amount of cash interest that is paid. The market rate, on the other hand, is the rate demanded by investors for this type of bond. You can also think of the market rate as roughly what similar instruments on the market are paying investors. The market rate is used to calculate the price of the bond. We will not be covering the bond price calculation in this tutorial video. It's enough to know now what the market price is. While the bond issuer pays back the face value of the bond at maturity, they also pay interest throughout the life of the bond. Interest is paid on the face value or maturity value of the bond. As stated before, the coupon rate on the bond is used to calculate cash interest. If a bond does not have a coupon rate, the stated rate is used. Bonds typically pay interest on a semi-annual basis, which means they pay half the annual amount of the interest twice a year. The calculation for the semi-annual interest is the face value of the bond times the coupon rate times 6 divided by 12. Let me talk about that 6 divided by 12 for a minute. The 6 stands for the number of months. The 12 is the number of months in a year. 6 divided by 12 is 1/2, which is what we want for semi-annual interest. This formula is useful for prorating interest over different months too. So if an organization needs to accrue interest for, say, 2 months, this formula can still be used. The organization would take the face value times coupon rate times 2 divided by 12. Bonds can sell at par, a discount, or a premium. If the coupon rate equals the market rate, bonds will sell at par value. If the coupon rate is less than the market rate, the bond will sell at a discount or less than its face value. If the coupon rate is greater than the market rate, the bond will sell at a premium or for more than its face value. So let's go through an example now. Let's say that an organization issued $10,000 of 5-year bonds at par on November 1st, 2022 with a 4% coupon rate. The first question is, what were the cash proceeds from the bond issuance? Well, the answer is $10,000 because the bonds were issued at par or 100% of the face value. Now for the second question, same example. What is the amount of the cash interest paid semi-annually on these bonds? To answer this question, we would take $10,000 and multiply by the coupon rate of 4% and then multiply by 6 months divided by 12 months to get $200 for the semi-annual cash interest paid. For the third question for this example, how much interest expense would the bond issuer accrue at December 31st, 2022? The answer would be calculated as the $10,000 face value times the 4% coupon rate times 2 months divided by 12 months to get $67. The 2 months comes from the time period of November 1st through December 31st. Also note that I have rounded the interest amount to the nearest whole dollar here. For the last question for this bond issuance example, How does the issuance of the bonds impact the bond issuer's balance sheet on the date of the bond issuance? So first, we know that cash is received, so assets increase. The bond issuer now has an obligation to pay back the bond at maturity, so liabilities increase. In summary, both assets and liabilities increase from a bond issuance. Okay, that's it. We are done. This video was created and narrated by Dr. Wendy Tietz. Have a great day.